Good afternoon and welcome. For those of you who don't know me, I'm Darren Lowry, Head of Sales here at Nucleus. Today we're back with another Illuminate live online event. These events are designed to bring you, our community, brilliant speakers with new perspectives and ideas to support your business. It's brilliant to see so many of you who have attended our previous events returning, and a big welcome to those of you joining us for the very first time. Today's event is a tax year end special, taking a look at the main outcomes from the recent budget and what they mean for you and your clients. We are delighted to be joined again by Tony Wickenden and Claire Trott from Technical Connection. As any of you who have joined our Technical Connection events before will know, tax is never boring when Tony and Claire are involved, and I'm looking forward to hearing their insights today. I'll now hand you over to Natalie Holt, Content Editor at Nucleus, who will be leading today's discussion.
Thank you, Darren. So I'm going to be joined by Tony and Claire in just a sec, but before they join me, I've just got some housekeeping points to run through with you. So you'll see the chat function to the right of your screen, though if you're watching us in full screen, you might just need to come out of that in order to view it. If you're still seeing a register button, please click on that and give us your name and your email address, and that will mean that we can send you your CPD certificate after the event. Once you've registered, click on the speech bubble section where you can type in your questions and your comments. You'll also be able to see the questions being asked, and you can kind of upvote the ones that you really want me to ask Tony and Claire. If you have any technical issues during this session, there is an FAQs link to the right of the window which should help you out. But if failing that, you can always drop a note to our events team, who are available at events@nucleusfinancial.com. So by joining us today, you will earn up to 1 hour of CPD. And as part of this discussion, you'll be able to meet the following learning objectives. These are as follows: to describe the tax changes as announced in the March budget, to explain the ways in which changes may be impacting your clients, and you'll also be able to take steps to change your financial planning strategy to respond to the changes that have been announced. So without further ado then, I'm going to bring on Tony and Claire by the magic of technology, hopefully, and we're going to start a bit of a discussion really around the budget and a bit of a delve into what it means for you and your clients. So just by way of an introduction then, for those of you who don't know already, Tony is Joint Managing Director of Technical Connection and Claire is Head of Pension Strategy. So we should be covered regardless for all your techie tax planning type questions. I'm going to run this session as more of a conversation, so that means more chat and less PowerPoint. The only other thing I needed to say was just to send us your questions and comments in the chat, as I've mentioned, and I'll aim to get through them as part of the discussion, really. So, Tony, I'm going to start with you, if I may, and I thought it would be good to just get a sense of the backdrop to the budget, really, and why we got the budget that we did.
Yeah, it's sort of history now, but we had a long sort of run into it, really, and the backdrop was debt, the amount that we owed, and that's really infused the much used word, probably the most used word over the last, the narrative, which everyone seems to be using quite a lot, but that did underpin the narrative for the budget. So it was basically big debt. And I've had some really great crash courses in economics and stuff by one of our person in our actuarial team. So basically you have 2.3 trillion is the amount that we owe as a country. I'll just like to state in these numbers, 2.3 trillion, and then the deficit, and that's largely gilts really, and national savings, and then the deficit being the difference between what we get in by way of GDP and what we owe, and it's just and what we spend, and it's 400 billion roughly. So they're big numbers. They're not necessarily unprecedented, because one of the other things we've heard, the highest debt in peacetime. So yeah, it's been worse in the war, but still big numbers. So the narrative was really, we need to do something about that, and that led to the concern that people have had about when will tax go up, because how do you pay back debt that's government debt, really getting money in from people and companies, tax. And then we've had, nicely to sort of deflect that a bit, as the International Monetary Fund and the OECD say, actually don't go too hard at the minute, because that will destroy the economy, and it's already pretty destroyed. Actually not as destroyed as we thought it might be, but just let's try and encourage growth in the economy first and then do the tax thing, look at debt. So that was what the Chancellor went into the budget with. That was the backdrop of going into economic support, followed by sort of a roadmap, maybe the start of a drawing towards a roadmap, which we did get, and a couple of steps taken as well, which we'll cover when we talk. So that was it: debt, the need to repay it, but let's support the economy. And so the overweight, it was really overweight in economic support measures and underweight, or not underweight in relation to expectations, because that's what we expected. So we got what we expected, really, a budget that was predominantly about support, but started at an indication of what the movement might be in relation to taxation.
Okay.
Big long answer to a very straightforward question. Sorry.
I like that, the drawing of a roadmap. That's quite tentative steps. We've got.
It was, yeah. So like if you had an Etch-a-Sketch, you'd have just got a few little, the charcoal bits, just little filings. You'd have just started it, really. Yeah.
Right. Before we go down that road too much, I'm going to bring in Claire now.
Shake the thing. We'll go back to the start.
And maybe just Claire, just to start with you, I mean, I don't think there were huge pension changes, but maybe you could talk through some of the highlights from that pensions perspective.
Yeah, sure. I mean, I think what we could start with is what didn't change, and we weren't expecting huge changes. Although, as ever, there's always we owe loads of money, let's go after the pensions and take the tax relief from that. Thankfully, we didn't see that. So we didn't see any changes to the annual allowance. We didn't see any changes to the MPAA, unfortunately. We didn't see any more changes to the taper, unfortunately, as I've spent probably the last 3 weeks helping people with taper calcs. I'd love them to be scrapped. I'd have so much more time in my day. So we didn't see any of those changes, which for the good or for the bad, but it's consistency. So that's, in a way, it's good because we know where we stand, we know what we can contribute, and we know what tax relief we're going to get for the rest of this tax year, at least. But what we did see was the freezing of the lifetime allowance. And although it was trailed, it still feels a bit of a shame. We were going to see a very small increase at the turn of this tax year, less than £6,000 on over £1 million. So we're stuck with the 1.0731 million for the next 5 years. So up until the end of 25-26, I would desperate for them to round it up. Every other chancellor has rounded it up to a sensible number, but no, we didn't see that. So that's what we've seen. There were a few other things regarding funds and encouraging investment in certain funds, but for us, the main focus is the lifetime allowance, and that is now frozen, and we're not going to get those CPI increases for the next 5 years. So fairly tame on the pensions world.
Okay, thank you for that. And Tony, do you want to maybe start to tackle some of the other changes that we saw, and then we'll delve into the detail a little bit?
No, I don't want to.
No.
No, sorry, that was, sorry.
Wow, I would really have to ban for time in that case.
Straight onto the slides here. No, so a point I forgot to mention to that first question is that's come up in the press since the budget, and people have picked up on, is we were all fairly benign about, we can afford the debt. It's really cheap. It's cheap borrowing, and it's a bit like getting mortgages, really, really, really cheap borrowing. But the risk of the interest rates and inflation could bring to that exposure that the government have. I think the Chancellor said, the one thing, I'm sure there's loads of things, but one of the things that keeps him awake at night, apart from wondering which bracelet to wear the next day to go with his skinny tie, is if interest rates go up, what will that do to the ability to service government debt, or if we get a bit of inflation? Because inflation, on the one hand, is good because it reduces, in terms of the debt, reduces the real value of the debt over time, and that played really strongly with wartime debt over time. It became, it didn't mean that much by the time you come to redeem that long-dated gilt. But in this case, because now roughly a quarter of the gilts that are issued are index-linked, you haven't got a fixed interest rate, it is index-linked, and if the RPI went up, apparently that would increase borrowing costs by sort of about 6 billion a year if it went up by 1%. And if there was an interest rate increase, you think, well, that's all right, because we're issuing a gilt which has a fixed rate of interest. But the way in which quantitative easing works, I still haven't quite understood. But basically, the interest rate has quite an impact on there. So 1% increase in interest rates could increase the cost of about 8 billion. So 1% on inflation, 1% on interest rates equals about 15 billion more a year to service the debt. So it's not without risk. So that was that small point I wanted to make. Now to your question. What was it? What's happened in relation to
changes, please?
Yeah. So I suppose the there was, apart from support, I mean, government support, there was a lot of change in that, and largely all very good, wasn't it? I suppose the definition being support. So if you know, the extension of the furlough scheme, the job retention scheme through till September, and I won't do the detail, there is a lot of this on TechLink, but you know, with a slight change from July and August, with requiring more of an employer contribution, the extension of the self-employed income support scheme till September with the 4th and 5th grants, and the bringing in of people who couldn't have claimed under the 1 to 3 grants, people who hadn't submitted tax returns, you know, for the early years. Now, if you've submitted a 2019-20 tax return, you can claim for the first time. Provided you can say that you have been affected by coronavirus. And then the 5th grant with a slightly more rigorous test, saying you need to effectively claim and corroborate the fact that at some point you'll be asked for the corroboration that your profits have actually reduced, and the amount of your claim will be dependent on the extent to which your profits have reduced. So they've got a little tougher around that. The mortgage support that we've got with the mortgage guarantee scheme, the stamp duty holiday continuum, which many people embrace and like, you know, the extension through of the 500,000 nil rate ban for a couple more months, and then even at 250 is still all good. So all of that was good, and loads of change to business support and business borrowing and all of that. But I suppose from our standpoint, looking at what went on in our market to show that to the financial planning market, all of that is related to financial planning, but the two direct changes that will be those applying to individuals and those applying to corporate companies and businesses. So the individual changes first, I think, and that was largely all in the freezing. Claire's already mentioned, you know, freezing, and there's more freezing going on with stealth tax, effectively, you know, freezing the personal allowance, not at its current level of 12.5, but an extra 70 quid, you know, at 12.570, I think it, sorry, 12.3. Yeah, so it's sort of £70 more at 12.570 it remains. The thresholds go up by a little bit more as well, but it's frozen for the next 5 years. And so that will drag in more people into the higher rates of tax if the thresholds remain broadly the same for higher rates and additional rates, and money does increase, salaries do increase. If they do, to the extent your money increases, there'll be more higher rate taxpayers. It's reckoned by 25, 26, the end of 26, there would be, it's 1 in 6 people will be higher rate taxpayers. That's 11% of all adults. 1 in 6 taxpayers will be higher rate or additional rate taxpayers. And the simple leap, maybe too simplistic, but when your tax rate is higher, you are more likely to be drawn towards the need for financial advice, probably because tax becomes a bigger part of your life and you want to do something about it more, generally speaking. So I think one side of it is obviously it's bad, but from a good side, from the financial planning standpoint, there should be more people interested in it, from the individual standpoint. We'll talk a bit more about planning perhaps later, but the other highlight was really around corporate. Should I do this? Should I do that corporate bit now, and then Claire can talk a bit more about pensions? So yeah, the corporate and business rates, we've got the main thing there was like we're going to increase corporate tax rates. There's a lot of debate over this. The freezing and the increase to corporate tax rates were both very well trailed. You know, leading up to the budget, it was all over the press, and so it wasn't a terrible surprise. Although the amount of the increase was, when it was over a 30% increase in the rate from 19 to 25%. And so you look at that being, that is a big increase, and it keeps us just about at the average level of corporate tax rates in the G20 nations, OECD. Broadly speaking, it's the average. And we were well below average. And some people are expressing a little concern, saying that makes us perhaps a little less competitive, well, definitely a little less competitive as a place to do business with a higher corporation tax rate, albeit not higher than, you know, elsewhere. Still considerably lower than France and Germany, but nevertheless higher, and we're outside the club, you know, as it were, we're not in the EU, so shouldn't we keep our rates low? And some people have even said, yeah, by the time we get there, because this is from the 2023 financial year, if the economy does rebound and does do well, then they might need to do it, because it'll be nearest to the election, maybe they won't do it. But at the moment it's scheduled in there. So along with it, when the last point I'll just highlight is the super deduction and losses. So the ability to carry back losses, unfortunately, as we know, many businesses have made losses. Many haven't in certain sectors, and ours is probably one of them. Well, we've done comparatively well out of the pandemic generally. But losses you could carry back now for up to 3 years. So that's both non-incorporated and incorporated businesses. And then you've got this super deduction, which sounds like a kids' cartoon, but basically, it's, you know, you read 130% relief. So does that mean if you spent 100,000, you get 130,000 pound lower tax bill? No, it doesn't. It means you can set off 130,000 of expenditure against your tax bill, 130% of your actual expenditure against your taxable profits. So what that would mean is if you spent £100,000, you will get tax relief for £130,000, and 19% of £130,000 is just short of 25,000. So it's roughly the tax saving is 25p in the pound, you know, for every qualifying pound you spend on plant and machinery, which includes computer equipment. And to a discussion, Claire and I had tables and chairs and desks and stuff in offices as well, of which there are as many empty tables and chairs. Cue Les Miserables. So sorry about that. So all those guitars behind me got me feeling musical. Well, I'm going to stop for a minute because I've talked far too long. We're going to talk about planning in a bit in a minute. But in that corporate sense, you know, the fact that if tax rates do go up, then that does make reducing tax the same way as it does for individuals slightly more attractive and important, especially if it goes up to 25%. And we all know one of the best ways to reduce corporation tax for the benefit of the owners and the employees is pension contributions. So
segue into okay.
Yeah. Really clunky there.
I think you talked about the lifetime allowance earlier, and I'm going to try and avoid the echo. But what do you think that? And you talked about kind of the fact that they missed that opportunity to kind of make it a nice round number. But what do you think it actually means, that freezing means, in terms of pension planning and financial planning more generally, do you think?
I think it's just a reminder that things need to be reviewed. And I know most of the people watching this will have regular reviews with their clients, but it's just a reminder of just looking at what they've got, where they are against the lifetime allowance, and getting some good sturdy estimates from schemes. I thought the one that recently has sort of made me think is lots of people have their DB schemes and date left service. You know, they haven't got an up-to-date figure for what it might be against the lifetime allowance. So they may be merrily funding a money purchase scheme without consideration of how much that will have increased, or if they're going to possibly do a transfer. And obviously, as we know, the CETVs are much more than the 20 times multiple that you have for the testing the DB scheme against the lifetime allowance. So I think it's just understanding all the moving parts and how they relate to this fixed amount. In a way, it makes planning easier because we've got a fixed amount. We don't need to guess or do projections of what the lifetime allowance may be. I remember saying when it dropped down to the million, it's going to take 8 years to get back to the 1.25. Not anymore. It's going to take a lot longer than that. But we don't know in the 5 years what's going to then happen. So are they going to go back to CPI increases, or are they going to just pick random numbers that they want to, or are they just going to continue the freeze? So it makes planning easier in one sense in the short term, but makes planning a lot harder in the long term, because we can make estimates and we can get illustrations and we can do projections on what we're doing, the contributions we're making, but we don't have a good feel for what the lifetime allowance will be after that 5 years. And for a lot of us, got plenty of years until I can get my hands on my money. I'm nowhere near the lifetime allowance, but I hope to be. But I also hope it's going to be a lot higher by the time I get there. So the lifetime allowance isn't just a worry for those people at retirement. It's a worry for those people funding and maximising their contributions now, assuming they've got a good base. I think if you're just to be utilising what you can possibly do and you're just starting out in your career, it's probably less of a worry. But if you've got a good base and maybe a DB thrown in there, then it's a case of just trying to just make reasonable estimates and get the most up-to-date information that you possibly can. And that's really surrounding the DB side of things, which can make a massive difference, obviously, with the multiples. And anyone who's crystallised before 2006, for example, those benefits utilise 25 times the pension in payment at the point they're tested. And we're just seeing a few of those popping up at the moment that people are going, oh, it was keeping pace with inflation, so it didn't make a lot of difference. But now the pension's going up and the lifetime allowance is at a set level. So all that time it's eroding it. And they're going, oh, well, we need to crystallise £1 or £10 or whatever to get that test done against the lifetime allowance. So there's all these little bits to just consider when we just know that it's not going up. I do hope that it will be another one of these surprise, we're going to put it up because we're coming up to an election at the point when we get there. Yeah, you never know. These may all be negatives that suddenly become positives. You just never know.
Mm.
Yeah, we did actually get a question around this. I think it was ahead of the budget, but it was sort of, the expectation and murmurings around lifetime allowance being increased back to the old levels. So obviously the budget dashed those, but we live in hope, hey, in terms of
we do
getting it up there in future.
Yeah, and I think obviously the multiples that are used and the disparity between DB and DC really does need a review. So maybe we hope that there's a review and they at least consider how these are tested, even if they don't necessarily change the levels.
Okay. And Tony, I suppose with any budget, there's going to be different kind of categories and types of clients affected. It might be kind of parents and grandparents, it might be people in the run up to retirement, it might be people drawing down an income, all of that kind of thing. And we just sort of touched on the corporation tax piece, but maybe you could sort of talk a little bit more about sort of the impact of the budget on on business owners and what they maybe need to do between now and 2023.
Yeah, and I should also, thanks Natalie, just add a bit more detail. And of course that 25% rate only applies to profits in excess of 250,000 as scheduled at the moment. If your profits are under 50,000, and we're going back to an old way of sort of working out tax now, then you will have the lower rate of 19%. And in between, we haven't got it published yet. It will be effectively a marginal rate, so a sliding scale to move it up. So effectively, you tend to get a higher rate on profits exceeding an effective rate exceeding 50,000 to drag the average gradually up from 19 to 25, which makes contributions to pensions and other deductible expenses out of profits that would otherwise fall between 50 and 250,000. There's so many areas of tax where you get this oddness of a spike in a rate, an effective rate. I mean, that definitely happens with pensions, doesn't it, Claire? I mean, if you've got the, child benefit and all that kind of stuff, it makes a massive difference. Just to bring you in on that point before I move on to the other bit.
Yeah, definitely. I mean, regarding the corporation tax, obviously, pension contributions are an allowable business expense, and you use your allowable business expense generally to reduce your profits. So that's one of the best ways to extract money from a business is through pension contributions, because not only do you get the saving on the corporation tax, you also get saving on national insurance, so the employer doesn't need to pay national insurance, and the individual themselves will also get a national insurance saving if they get a pension contribution versus actually getting a salary. So the most tax efficient is pensions. The next tax efficient is dividends, because you still have that NI saving, but it's not, you don't get a corporation tax relief, so it's not allowable business expense because you're extracting it. And then salary, you do get it as an allowable business expense, but national insurance at 13.8% kind of negates some of that. So it's not the most efficient. And then if you are the owner manager and you're paying yourself a salary, you're going to pay income tax on top of that national insurance as well. So pension contributions, absolutely brilliant way to reduce your corporation tax. So when we do get the higher rates, absolutely brilliant. However, as reminded by another one of our colleagues, you can't buy groceries with your pension contributions until you're old enough, which might be 50, 55, might be 57. Obviously, we've got that going up as well in 2028. So it's weighing up all those factors to decide whether or not it's going to be worthwhile making those contributions. But if you need money to live on, it's going to be dividends or it's going to be salary, because we do all still need to buy groceries, unfortunately.
Yeah, I mean, I think that point on extraction strategies, as it were, we're not waiting till 2023 to do this. That's relevant now. It's just we've got different tax rates, and what we will see with an increased corporation tax rate, if that comes to pass, will be another change to the nuancing of dividend or salary. Into the dividend will be profits after corporation tax, which will be at a higher rate, and it will narrow further that difference between dividend and salary, because the dividend source will have suffered a higher rate of tax. So that will be something to be looked at in the future. Right now, it's something that I think the financial planner, well, I know, should be at the centre of each year, having this discussion in working with the client and professional connections to work out what's best for that particular client, taking account of the points that Claire's made, not just everything based on tax, but how much money do you start with? How much money do you need and want, first of all, and then work with any surplus? I think really also remember those the freezing of the personal allowances and thresholds. The thresholds in particular also apply for national insurance, because the upper earnings limit and upper profits limit is linked to that higher rate threshold. So it has an impact there too. So all of that to take into account. And the point on losses, if you've got them, this new facility will work. It's a sort of 2-year period that if you've got an accounting period that ended between the 1st of April 2020 and the 31st, not if you, 4 accounting periods that end between the 1st of April 2020 and the 31st of March 2022, then a period ending, losses made in accounting periods ending between those 2 dates can be, if it works for you, carried back up to 3 years. And we think you'd have a loss. Actually, we've been asked this. I've been asked this just by one person. If that loss arose because of a pension contribution, because perhaps you had enough cash to make the contribution and then it made a tax loss because of the deduction, can you use that loss to carry that? Yeah, you can. The way in which you created the loss doesn't matter. If you got a super deduction, as it were, which caused a loss, then can you use that loss to carry that? Yes, you can. And another question I've been asked, these are just sort of random odd questions been asked since the budget, with some people hypothesizing and in some cases real questions, was, that will make UK investment bonds even, because most people start from that even, because bonds are largely seen as, wouldn't say toxic, I think wrongly so, but are almost, don't consider those anymore. I think there's a case for them in some cases, not by no means all, but in some. But that corporate tax rate increase, if it happens, will not apply to UK life policyholder funds, because that rate is linked to the basic rate. That's why UK life companies, the internal funds, suffer 20% tax on income other than dividend income, which is completely tax-free. This isn't meant to be a bond promoting session, it's just the fact. The corporate tax rate doesn't apply, it's 20%, not 19%. So it's slightly detrimental now, but in the future, it stays the same, unless they change the legislation, which there's no indication they will. So planning, business owners, no change dramatically, unless be aware of those super deductions, which if it's right from a business standpoint, we're always starting there, not from a tax standpoint, then it might be even more attractive to you to make the acquisition of the asset. If you get more tax relief, it reduces the cost, definitely. Do that year-end, pre-year-end remuneration planning. Definitely do that, as Claire suggested, even now, of course. And think about think about what that company's for. And too often, I think, as financial planners, we maybe don't have that conversation enough. What's this for? That classic thing of where you want to be. I know everyone seems to be somewhat obsessed with goals-based financial planning now. Essentially, all good financial planning will have been that, and most people don't present to you with their goals. I want to have this much money by this much time, all of that, they don't. It's about discovery, isn't it, and discussion. And most people articulate that in the sense of how they see their life in the future, what their possibilities are. Effectively, this is very Carl Richards-like, but that whole thing of just where you want to be expressed in terms of what's important to you and what your values are. And then you might be able to get a rough framework for what that looks like and work back with the financial goal to that and put in a financial number to that and work the plan out as in relation to the goal. The point with the company is, where does that play in that? It's a really important asset class, but one that is difficult to realise for most people unless you are intentional about where you want your business to be. And does it have a value to someone who wants to buy it? It might have a value to you, but does someone else, does it demonstrate all of those sort of things that make people go, yeah, I want to buy those qualities to buy it. So I think it's being intentional about that and having that discussion, testing yourself, where do you want to be and what part can your company play in that? And then the financial planning to shape the company to the extent the financial planning can help to get to that point where it is realizable, it does have a value. And in the meantime, protecting its value. I think that's all these things just prompt a conversation to remind us of the basic good fundamentals of financial planning, and the corporate in the middle, or the business, even if it's not incorporated, is such an important part. Recognizing that it is actually one of your key assets in your planning. And the other point there is, and therefore don't be overweight in your own business, as it were. I mean, that doesn't mean you have good eating habits and do your exercising, but I mean, overweight compared to your other investment assets. small attempt at a joke, which failed miserably. Okay, right. Okay.
So I'll dub in the hilarious laughter later.
That's great. Yeah, clap now.
So that's kind of the budget in a nutshell then, and that's kind of, even though allowances have been frozen, and we've kind of touched on that in terms of scale taxes and things like that, that's already a lot of ground covered, but there is a bit more to come later this month, if I'm thinking rightly. Is that right? In terms of
there are some consultations that will be issued. There was a Treasury press release a couple of weeks ago, and the Chief Financial Secretary to the Treasury, getting all detailed about this, with an accompanying letter, said several of the, basically, first, this was done pre-budget. We're making it simpler because budget day, which is always this day of great excitement for Claire and I and the rest of our team, but you're overwhelmed with stuff that comes out and you have to sift to go, when does this apply from? Is this happening now or sometime later? So everything's chucked at you all at the one time, the Red Book and the OOTLA and all the consultations and all of the press releases, to sift them out. And they said, we'll do that for you effectively. So all the stuff that isn't to do with change that will be actioned in the next tax year and will be in the finance bill, we're going to publish that later. So all of the discussion and the consultation, we're going to take a breather, and that's going to be 20 days later, in this case, on the 23rd, which is only next week now. So consultations. Then he said also several of these consultations will be about the administration of tax and the digitalization or digitization of tax. I always find that difficult. It's like my dad could never say digital. He always said, yeah, I've got that digital, that Sky digital boy, he always said. Anyway, so digitizing tax. He said several, not all of them. And that leaves us thinking, right, so maybe more of this roadmap for the consultations might be about stuff that hasn't been dealt with, doesn't need to be dealt with, needs time to be thought about and discussed, that hasn't been said so far. And I mean, Claire and I have had this discussion quite a lot, but one of those areas, if there is going to be an area that actually needs a lot of thought, because it's not as easy as it might seem, is pensions, isn't it? I'll come back to some other stuff, but this is probably the one most people are most concerned about. What might happen?
Yeah. I think it's safe to say, and whenever anyone asks me, and Tony does quite often, as to can't we just make it easy? It's usually the thing. Well, if you look at where we are and look at what we've got, making changes to pensions tax relief or any of the ways in which the tax relief is limited is very complex. So we did see the Public Accounts Committee last year, so last summer, saying we're not sure the tax relief is going to the appropriate places. Higher rate are getting much more than the basic rate, and nil rate aren't necessarily getting what they should be getting. So is it going to the right places? We think you need to do a review. The government came back in September, and what they said was, not again. No, they didn't quite say that. They very nearly did, because what they did say is, well, we did one back in 2015. We've reviewed this, and there's never been a major consensus that it's not necessarily going to the right places. So they did say at that point, actually, we're not going to review anything for the next 12 months. So if you think September to September, it means, in theory, we shouldn't be expecting anything. But they could announce a consultation that is going to come about later in the year. So it is a possibility we might still see something. But I think it's important to note, and as Tony said, it's complex. And the majority of the tax relief that is given actually goes to employers. It doesn't necessarily go to these high earners that they're all talking about. That they're saying all this high rate tax relief and this additional rate tax relief is going to the wrong people. The majority of pensions tax relief goes to employers, and goes to employers who are funding DB schemes. So if you were to actually try and take away that tax relief, then it would have a real detriment to the DB schemes, which obviously we're not talking necessarily the public sector DB schemes, but we would be talking the ones that still remain for your average bod like ourselves. So it could be a real detriment if they were to do it, and I think that's what would come out. Should a review happen, but it doesn't mean that they won't do it, and it doesn't mean we won't get any new ideas, which is an important thing with consultations, is the ideas that come from the outside and are brought to the government's attention. So I always urge financial advisors to get involved in these. So if there is a pensions tax relief consultation, then do get involved and give your ideas, because I'm sure you're at the coalface, you're seeing all the changes and all the issues regarding things like the taper. So if we were to scrap that, life would be so much simpler for the majority of us, which would be, a real benefit. But that's the one that we kind of expect to see, but don't. So it's a bit of I'm in two minds. Will it or won't it? We'll just have to wait and see. We'll be sat there on the 23rd going, oh, it's a year since lockdown, and oh, we have to do our minute silence, but I need to check these consultations just quickly.
Yeah, no, I guess we can't kind of let go of those circular rumours that come around about pensions tax relief just yet, whether that's next week or September or any time in between.
I don't think they'll ever disappear, those because
the pensions without it, would it?
And they are seen as low-hanging fruit. So people see there's a lot of tax relief, whether it goes to the right people or not. And people think actually we could end up saving a lot of money for the government, were it to be changed. I just think the cost of change might be a little bit extreme.
And I guess they have already identified that 40, 50 billion odd that's kind of there for the taking, so to speak.
Yeah, although I dispute the numbers ever so slightly given the way they worked out, but that's not for today. That's another argument.
Well, there's also the point, isn't there? I think you think, tax relief is given to incentivise people to change behaviours, and if the idea of it is to get more people to save, but reshape where the relief goes to, and if that relief then is, you'd argue, if that's what you want, if the motivation is not to save money, but is to change behaviours or a bit of both, then if you do give more to basic rate taxpayers, as it were, so a flat rate but higher than its current rate, because then you're not incentivising them anymore, maybe characterising it different, then if it works, then arguably you could end up spending more because more people do it, as it were, than it could, so it depends on what their motivation is. But as Claire said, and you have, Natalie, it is very sort of potentially low-hanging, juicy sort of ripe fruit of whatever the number is, but it's a lot of billions, whatever it is, really. Yeah.
Okay. So with all of that in mind, then,
there's a bit more actually. I mean, I'm sorry about. I deferred to Claire because I always do, but just that point of what else could be consulted on. Maybe you were going to ask that, so I talked over you. So sorry for that. But
it's all right. Claire, what else do you think they could consult on?
Oh, no, that was me. I was thinking you asked me, and then I thought, I'll ask Claire because pensions is the most important thing. But the other thing is capital taxation that probably needs the degree of thought. We've all gone way off script here, but the degree of thought that needs to be given if you're going to make any change, rather than making a change and repenting at leisure and having to do another U-turn. So I think, thoughtful consideration to something. The two areas I think are there are for possible just an overall reform. And we did get some indication that was in the Chancellor's mind when we were talking about the early days of furlough and self-employed income support scheme. And there was people who would still feel hard done by, owner managers, personal service companies who go, they've fallen through the gap. If you took your money by way of dividend, then you can't anchor a furlough payment to the dividend. And there's almost a sense that it's just, serves you right for taking a dividend. So there was a sense of that. And then there was the self-employed are getting stuff and they haven't getting support, but they haven't paid as much national insurance. And then we've had all of the Uber and the digital, the gig economy. And the Chancellor just going, wait a minute, the way in which we all work now, which we all know, we're proving it now, the way in which we work, the style of working, nature of how we're employed or not employed has changed so much over time. Maybe there's time for a big review of the taxation of employment and self-employment generally and how national insurance works, and maybe crunching together national insurance and income tax. So that's massive. So that kind of review definitely would need consultation. That's one thing, but without without any change to income tax rates, VAT rates or national insurance rates, because they promised they wouldn't in the manifesto, and the Prime Minister seems to think that's an important thing. And then there's capital taxation, where we've had, and this is the one that maybe will go as favourite out of all of the changes, because two chancellors have asked the Office of Tax Simplification, I've mentioned this before, but to look at those capital taxes. Philip Hammond asked the OTS to look at inheritance tax, and they did, and made their two reports, and they've been sitting there for a couple of years waiting for something to be done with them, or maybe they've just been looked at and thrown away. But just, I think, preoccupation with other more pressing things has been the reason. And then more recently, Rishi Sunak has asked the OTS only last year to a much wider brief review capital gains tax, and they've come up with some quite radical suggestions of relinking capital gains to income tax more than it is now, actually taxing capital gains as income, removing the wipeout of capital gains on debt, reintroducing indexation relief if you're going to link it to income tax, more harshly taxing cash in companies because they see it as a way of holding money and then winding the company up and getting the money out subject to CGT rather than income tax, even though there's some anti-avoidance provisions on that already. Reducing the annual allowance, changing business assets disposal relief, used to be called entrepreneurs relief, maybe getting rid of it. So all of that is quite radical and it's waiting there to be looked at, maybe as part of an overall reform, because the IHT reform suggestions were a little more benign, although there was an all-party parliamentary group for intergenerational and inheritance fairness. Yep, there really is a group called that, the APPGIIF, who made some more radical suggestions. So they're out there too. And then we've had that Wealth Tax Commission, which is not a government body, but just came up with some ideas on wealth tax, which we don't think is anywhere near being acceptable to Conservative government, really don't. But it just gives you the whole thing. Maybe we should review capital taxes as a whole. And there's a lot of that goes to the very heart of financial planning, intergenerational planning, especially, which is so important to so many advisors, that intergenerational planning, taking an intergenerational approach to financial planning. Capital tax is really important. So that could be something that maybe if you were doing, that would be the favourite, just because the OTS, who are a Treasury body, have been asked to look. So you'd expect the chance to go, well, I did ask them, so now I'm having a look. Who knows? We'll see next week. Can't wait.
It's like 2 budget days in 1 month for you. So just to kind of recap then, Claire, I wonder if kind of given everything that you've talked about, in particular with regards to kind of pensions and planning, are there specific takeaways or action points for planners that they should be doing at the moment, bearing in mind what's been said about future change and consultations and all the rest of it?
I think it's your usual tax year end stuff, which I do urge people not to do these things tax year end, but given the things like the taper and understanding what people's earnings are, particularly this year, which could be sort of, very changeable, then I think it's a case of looking at carry forward, maximising contributions, and just thinking actually furlough is relevant UK earnings, and the SEISS is relevant UK earnings. I had to ask the government that because it wasn't clear, and they've told me they're going to update the guidance, so that will be relevant UK earnings. So you can pension those if you need to, or if you want to, say you're coming up to retirement. So just understanding what you've got available, what contributions you can make, how you can save on the tax, and doing it all as soon as, because we really are getting towards the end of the tax year. As I'm forever reminding Tony, tax year ends the 1st of April this year. It's not a joke. You must make sure that you get it done before then, because we've got Easter in the way. But I'm looking forward to a long weekend, I have to say, even though we're not going anywhere.
You'd be a fool not to, wouldn't you? First of April. You'd be a fool not to.
You would be a fool not to, most definitely.
Joke. There you go.
So usual tax year end stuff. And regarding the lifetime allowance, I think it's having a really good understanding on what your clients have got and what the impact is. But do remember, the lifetime allowance is an allowance. It's not a hard and fast limit. So if they do go over it, what they're going to do is they're going to lose a bit of their tax relief by the way of the tax charge, but it may still be beneficial for them for various other reasons, such as IHT planning, because what you can do is it will still be outside your estate for IHT and things like that. So it's factoring in all the other bits, and you can't look at pensions on their own. The real benefit working in technical connection, I can look at pensions on their own and then ask Tony or Nikki or somebody, how does this impact? How do the other taxes impact? And that's really important with the way everything slots together. And now is a really good time to consider that.
And then, so Tony, from your perspective, what would you kind of add to that in terms of key takeaways or action points for planners?
Same basis in that, we have got year end, and last minute planning definitely worth considering, but the year start is probably the best thing to do, and to look at, while you're having that conversation, look to not be in the same position this time, not next year, if you're thinking of year end, to just plan the year ahead, because you'll have a full year to make some of those things work. If you wanted to drive income to use the personal allowance of one of a couple which isn't being used, anything to do with income where you haven't got control of the source is very difficult to do last minute. You can do some capital tax planning because it's sort of chunky, and you can do a disposal maybe and a reacquisition, all that. But with income, it needs to flow through the year, unless you own your own business, so you can pay out a last minute dividend or something. So on the whole, I'd say advanced planning, much better. Think about all of those allowances and exemptions that you'll lose if you don't use them. And bear in mind the freezing as well that's now going to happen. So, you know, the great news is there's not a freezing, but they haven't reduced them. The ISA allowance, obviously, the JISA allowance for grandparents and parents thinking of investing for children, the pensions allowance for children, the effect of compounding when you advance, you save, all of that good basic sort of homespun stuff around planning that, you know, it's so obvious that we sometimes don't talk about it enough. So run a sort of tax health check towards the end of the year with a view to setting things up right for the next year. On inheritance tax, it was quite the latest YouGov survey, which was a couple of years back now. It did indicate that inheritance tax is the most hated tax, or the tax that people dislike most out of all the personal taxes. And there will be more people subject to inheritance tax, just as there will be those increased number of higher rate taxpayers that I mentioned. The freezing of allowances goes to the CGT freezing, the 12,300, that'll stay there. We could have a change, a more radical change, as I said, to CGT, but the IHT nil rate threshold, more freezing, the residence nil rate ban, more freezing, the annual exemption, you know, all of that stays. But so definitely use it, because people are wanting to do something about that, really. And my last point, and it's a bit of a sort of a passion point for me now at the moment, I think a bit of a drive on this is that, and we've been reminded to be quite sensitive about that, but through this whole time about, you know, all about mortality and health and all that kind of stuff, and just say, you know, life insurance, I know it's not sort of in favour, as it were. Generally, it doesn't get talked about much in a community understandably sort of consumed by wealth appreciation and preservation. That whole thing of the what if factor, you know, a plan's one thing, but what if you don't make it? Basically, that hierarchy of needs, I'd always put protection up there pretty much at the top of that, really, to have a look at it. You know, there's some great ways of tax saving with life insurance as well, especially if you own your own business, or you can get, you know, relevant life for tax deductible life insurance, even more appealing if the corporate tax rate goes up and individual thresholds remain frozen. So yeah, that's my thing. Think about it in the whole, plan ahead, and don't forget insurance protection.
Okay, great. Thank you for that. So I'm going to move to take some of the questions that we've had in via various channels and things. So we have had one from Trevor Whiting, who asked quite a specific question. So I'll just read it out. And he says, Tony, please could you elaborate on the two tests that would help companies circumvent the budget restrictions on R&D tax credits?
No, that's an honest answer. I'm going to have to look that one up, and I will look it up, and I will come back to you. So apologies.
Okay, that's fine.
Yeah, okay, R&D tax.
We'll return to that one then.
Good first answer, right? Honest, at least. Right.
Well, you know, no is no. That's fine.
Yeah. Only just for now. It's just for now. I'm going to look something up. Right. Okay.
That's okay. We'll come back to any questions that we can't answer just now. And then the other question that we've had come in is from Tim Woods. So hi to Tim. And he asks, why did they not reduce tax relief for higher earners instead of the usual lifetime allowance adjustment, which only goes to penalise those who invest well and early? Do they think they will reduce tax relief for higher additional rate pension contributions at some stage soon? So Claire, I guess we've kind of touched on this, but is there anything else you kind of want to add on that specific?
Yeah, I think it's the problem with trying to cap higher and additional rate tax relief for individuals is pension contributions are salary by another name. So if you think about your remuneration package, what you're doing is you're usually getting a pension contribution and you're getting some salary. So you're basically getting marginal rate relief on your pension contributions because the employer's putting them into your pension. So you could end up with a situation where you're having to P11D pension contributions. So you're restricting the higher rate tax relief for those people who are getting employer contributions. So that's where the complexity comes in. And that's where the annual allowance and the lifetime allowance are used as a sort of an overarching test to try and limit the amount of tax relief that's given to any one individual. And that's what the thing that they've seen when they've done these reviews in the past, that actually just trying to stop certain individuals getting the tax relief when we basically have the setup that we do now, that employers make quite a lot of the pension contributions, then that's where it becomes a bit sticky and a bit complex, and they can't quite get their heads around of sort of how to sort that. So my example's always been, if you're going to get a £40,000 employer contribution versus a £40,000 salary, and then you put that into your pension, you would get less tax relief if you put it in personally than if you had it from your employer. So that all needs to be factored into any changes they make. And I think that's what a review, again, might look at. They've had 5-6 years since the last review when they've looked at pensions tax relief. So, you know, different thinkers, different ideas, and slightly different tax structures, you know, might drive a different outcome. So I'd never say never, but I think it's something that's going to be really difficult to bring in that sense, unless we just have, you know, change the caps, which is why they've done what they've done, and why we are where we are.
Okay, thank you. We also had a question that came in from Virginder Verdi, or Verhinder. Sorry for mispronouncing the name. But I think they were quite keen to hear about coronavirus support schemes, which is slightly away from budget, but there might have been some updates to some of the schemes. And in particular, they wanted to hear about CBILS, or the Coronavirus Business Interruption Loan Scheme.
Loan scheme, yeah.
So
CBILS and the bounce back loans, they both end on the 31st of March, but they are being replaced, as I understand. It's not an area we practice in sort of daily, but we've already mentioned furlough and SEISS and business grants, business rates relief, all of that continues, so that's all good. The recovery loan scheme will then take over, as it were, slightly less attractive, and it runs until the 31st of December this year, I think. Loans, I think 25,000 to 10 million, so it's quite a wide band of borrowing. No personal guarantees, that's a good thing. So that reflects a little bit the CBILS thing. For loans, I'm just reading it, up to 250,000, and over and above that, only a personal guarantee required for 20% of the loan. Unfortunately, and up to 6 years with the term, but there's no interest payment cover. So the government aren't doing interest. I mean, there's been a lot of press over CBILS and how much of a sort of a cold the government are going to take on unrepaid loans, and people taking as just being unable to pay them back, and that is going to fall on the taxpayer. So I think they've been a little more cautious around that. But that recovery loan scheme, there's good detail on the Gov website. We certainly cover it with InTechLink. The main difference there is no interest payment cover, I think, really, but we still get the no personal guarantees for loans up to 250,000, and lenders are encouraged to, you know, be open to doing it, really. But I think they'll be a little more rigorous in their testing of giving the loans when there's no government backing on the interest cover.
Okay.
Yeah.
And kind of just while we're kind of on that, then we've had a question from Daniel Galbraith, who asks around furlough and SEISS, or self-employed income support scheme, and that he asks that both of those are classed as relevant. You mentioned that both of those are classed as relevant earnings and therefore pensionable. Further to that, can COVID loans be used by a pension scheme?
Oh, again, not one I necessarily know about. So
I think loans be used by, right? Okay, so can a pension scheme apply for a recovery loan scheme? Is that what that to borrow money?
Could you pay the COVID loan into the pension scheme? I'm guessing, but presumably the COVID loan, it's not for the pension. I don't know whether they're testing that, really.
Yeah, I mean, money within a business, you always need to be able to justify it as a allowable business expense. So is it for the purposes of business that the pension contribution is being made? And I think that might be where this might fall down somewhat. So the contribution itself in the pension, if it's coming from a business, the pension rules themselves will have no issue with it, because they don't care where the money came from. What your issue may be is whether or not you get corporation tax relief on the money that's going in, because you've got to be a justifiable business expense. And if you've got issues, or then it might not be seen as a wholly and exclusively for the purposes of the business, is what we always say. On the pension side of things, yeah, pension rules, we literally don't care. It comes from a business, and you won't be able to unwind it if it turns out you're not going to get your tax relief. So that's probably as much as we can give you. It'll be a case of talking to the individual accountant for any justification for paying money out of a business. The loans themselves, I'm not sure whether or not you need to give a reason, as you say, to take the loan, if there needs to be a purpose for it, and whether or not by getting that you use that for something that you would have used your capital for and then you use other capital for the pension contributions. So there's lots of sort of moving parts again. I would usually refer people back to their company accountant for these sort of things, because the company accountant will understand the workings of the individual business. We are always asked about allowable business expenses, and we don't know the individual companies, so we can't often comment. And the final say comes down to local tax inspector, which is always really helpful, because you won't get an opinion before you make the contribution.
I'd certainly add, yeah, from a commercial and economic standpoint, you've got to bear in mind you would then be borrowing. Like as Claire mentioned, I don't believe there is a purpose test, but when you go along to the bank to get the lender to get they'd want to know what you're using the money for, so that might cause a problem. Second point is, bear in mind, it is a loan, it does need to be repaid, the money's going into an environment that you can't readily take the money out of, so be prepared to do that. And it always gives me concern, even if you get tax relief, you are borrowing to invest. So you've got a hard known liability that you have to pay back, you have interest that you have to pay, and you're investing with the benefit of tax relief, I get that, into an environment that will grow tax efficiently. But there could be, keep in mind the cash flow aspects of it, of loan needs to be repaid, interest needs to be paid, borrowing to invest, slightly uncomfortable generally about that.
Yeah, okay, no, that's fine. And then I wanted to ask a question that came in from Michael Clark, which goes to the point around freezing and a bit of kind of looking to the future type stuff. But he says the Chancellor has deferred many of the more drastic tax changes, as we've mentioned, to CGT, IHT and pensions that many were forecasting. Given the timings around the next election, where and when do you see future tax changes happening? I suppose beyond the answers that we're going to get in the consultations next week, potentially.
Yeah, I could see certainly from a capital tax standpoint, because with taking account of that question around the election and the timing of that, then the good news from that standpoint is relatively few people pay inheritance tax and capital gains tax. Consider the number of estates that has been increasing that are subject to inheritance tax is still relatively small compared to the number of total estates that go through probate in a year. And then you've got capital gains tax. Last year, the tax year before this one coming to a close, I think capital gains tax was paid by 256,000 people. Not that many, and half of the CGT, which was about 10 billion, the yield, was paid by only 10,000 people. So if you are going to change that tax or reform capital taxation generally, and one can, I think, reasonably expect that to be not making it more attractive, a review, but it will get more money in. One, it looks like you are levelling up, and that whole new conservative philosophy saying we're not trying to just favour the rich. Two, it won't upset that many people, and so really coming to an election, number three, maybe it is something that could be considered. So I think the capital tax is one that could more likely be considered without massive electronic detriment. Pensions one definitely takes a lot of thinking and could affect lots more people. All that stuff around getting rid of tax-free cash and all that, that's massive electorally sort of incendiary stuff to do that, I think, really. Income tax rates, I don't see those being increased because they've promised not to, and that affects a lot of people. So that all comes into it. And freezing stuff is really easy, isn't it, really, because people don't properly understand it. Nothing changes now. Nothing changes. It's all right. You're not getting your pay back. And then over time, you start getting in lots of money, and people don't really notice. It's like the Charles Handy boiling frog thing. It just gradually happens, and then you look at, when you compare it back, apparently when you get to 20, 25, 26, the rate of that sort of threshold, high rate threshold, will in real terms be what it was back in 1991. That's effectively what it was. So that makes a big difference. It's going to continue to yield £8-10 billion a year just by the freezing, which no one really notices. So that kind of stuff, mixing real money with political, not being politically sensitive, and it all just going on, is a really so yeah, when it comes to all that frozen stuff, I tend to say let it go. There you go.
No, I was going to say it's been interesting, hasn't it? Because I think you always get the kind of analysis after the budget, and you did have that thing of, I think there was maybe a little bit of talk of stealth taxes in our bubble, but perhaps not wider.
Yeah.
And then I think there was also a poll that sort of suggested that people thought that Rishi Sunak delivered a really fair budget, and they were really positive about it. And so it will be interesting to see the politics of that work through.
Yeah, most definitely.
I guess.
Yeah, quite. Now next week will be interesting because it's the opportunity there, and of course then we do have another bite in around the autumn later. This is probably going to be November-ish, I would think, to see more could be, even if we don't get anything at this point, because it's still going to take a while for that to wind out to see truly what the economy is looking like. It's all feeling, slightly more positive. The figures we've had from the OBR saying the detriment over the last year hasn't been as bad as we thought it would be. People are sort of spending, and so I think that a bit of a wait and see, and maybe the start of something we might get next week, but by no means the end of it, I think. Yeah, lots for financial planners to do and be interested in, and I would really encourage to communicate with their client. Any change that comes. Number one, in that whole trust equation thing, if be credible and reliable, two of the real contributors to that. Be ready to answer questions from clients. Sorry if this sounds patronising, but when they ask you about things, don't be like I was when someone asked you about R&D credits. Be at least prepared to know. What are they? No, just sort of be ready to have the discussion seriously, and then when anything changes that you think is relevant to somebody, that whole saw this and thought of you goes such a long way in terms of the client relationship. I'd just encourage you to do that. I know it's hard in a very busy day, but that sort of stuff over time really pays off, I think, in terms of the relationship.
Okay, thank you. I think that's all we've got time for, actually. So thank you very much to Tony and Claire for fielding all of those questions. And thank you as well for watching at home, for submitting them however you did, whether ahead of time or during this session. So thanks very much for that. So just to recap then, we had some learning objectives at the start, and these are what we've covered. So you should now be able to describe the tax changes as announced in the March budget, explain the ways in which changes announced may impact your clients, and you should now be able to take steps to change your financial planning strategy to respond to the changes that have been announced. With all that in mind then, I think there's just a couple of more things for me to run through. So it's just to say that everyone who's attended this event will get an email with a short feedback survey. So once you've entered your details, that's what you'll get. Once you complete that, you'll get your CPD even certificate, and that will have a link to the event replay so that you can watch it back or you can share it with others. That's all from me. So thank you so much for watching and for joining us. I'm going to hand back to Darren now just for a quick summing up.
Thank you, Natalie and Tony and Claire, and I guess everyone for tuning in today. I hope you enjoyed the past hour with us and that it was a great use of your time. Please do let us know what you thought of today and anything you'd like to see us doing in the future. I'm pleased to inform you that Illuminate Live will be back in May with another great lineup, so look out for details in the next few weeks. That's all from us. Wishing you all good health, and we hope it won't be too long until we get to see you all again. So thank you.